Welcome to our Taking Stock video for the week ending the 17th of November 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Welcome back, Jason. I know you took some leave last week, but I hope you had a relaxing period.
It was fantastic as always, and it's always good to be back, Kien.
Yeah, great to have you back. But before we get started, just a quick yet important reminder. The information we provide during this episode is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any charts tables we present today shouldn't be relied upon as a guide for future performance. Well, it's been another week where share markets have been driven by the release of economic data, and weaker than expected inflation data, especially in the US, has driven optimism that the US Fed may be done raising rates. And this is inherent across all the bond markets as well, where bond yields are a reflection of interest rate expectations. They've declined since early in the month. In addition, an increasing number of economists are now anticipating a soft landing for the global economy, Jace.
Yeah, it's pretty interesting what's happening in the US. There is a lot of optimism over there. But locally in Australia, inflation remains a lot more sticky, Kien. And this is with wage data suggesting its fastest growth in the past 14 years, accelerating 4% year on year to the end of September, which came in above market expectations. The market is now divided on interest rate expectations, and there's a 50% probability that rates could rise around mid-2024.
Yeah, quite interesting, the disparity between us and the US, Jace. But despite the increasing optimism across the US, we remain cautious of the markets into the year. And we've just got to separate the facts from the noise, Jace. And those leading economic indicators, they suggest that a recession remains a strong possibility. And you can see this with the charts on screen showing the US Conference Board of Leading Economic Indicators, and that's turning lower. And also you can see the inversion of the bond yields, which have preceded recessions in the past. And you can see this with those charts on screen, and historical recessions are the ones shaded in grey.
That's right, Ken. So we are cautiously optimistic, but, investors shouldn't really fear this type of data, because of the fact that market timing can be a little bit dangerous and is a bit of an art rather than a pure science. So what should investors focus on? Well, risk management is very important. Avoid companies that are susceptible to recession risks and invest in financially healthy businesses.
Yeah, we've talked about this in our past episodes, so refer to that. But this week also marks the end of the bank reporting season, following updates from Commonwealth Bank and National Australia Bank. And overall, Jace, expenses are higher, net interest margins are becoming tighter, bad debts, though, remain low, and dividends appear sustainable for now. So for more information on that, please refer to Ryan's commentary.
That's right, Ken. And for investors that want to look at the data, well, you can compare the bank performances from the peer comparison table, which is located within the 9 Golden Rules page. Or you can simply navigate to Star Income Stocks portfolio under watch list, or even the stock filter, and then you can sort this by the industry group. So currently, if we have a look at the table, we've got Westpac and ANZ, which appear to be the most attractive in terms of forecast gross dividend yields at around 10%. However, investors should be mindful that the market is pricing in higher risks across these banks. And we'll speak more about these two companies later on in this episode.
Yes, thanks, Jace. On to other company announcements this week. One that you cover, gaming company Aristocrat Leisure. They released their financial year 23 financial result. And on first take, Jace, performance over the period, it came in slightly ahead of consensus expectations. Revenue grew 13%, while earnings were up 22%. So what drove this performance?
Well, Ken, growth in total revenue was driven by strong outright pokies machine sales in North America, and these were up 26% on FY22. In addition, there was an 8% growth in US gaming participation, which simply refers to the fee that Aristocrat receives for leasing their machines to casino operators. Furthermore, group earnings were supported by favorable currency movements and higher interest income from the excess cash that they have on their balance sheet.
Right. Breaking down the composition of the company's result, though, you did mention that land-based casino performance has been strong. However, I noticed that sales across its online or digital gaming segment was down about 4% on year. And given that they have been expanding into this area with numerous acquisitions, the latest being online lottery and gaming business Neo Games a few months ago, is this a concern for investors?
Yeah, that's an interesting question, and one that was sort of raised within the analyst call. From my perspective, I don't think it's a major risk for the company. Currently, the digital gaming segment represents around 42% of total revenue, and the decline in sales is representative of the abnormal player activity that we saw during COVID when there was a lot of stay-at-home mandates. In addition, the lower player activity that we saw in FY23 was driven by an exit from the Russian market, which made up 3% of overall bookings. I mean, over the longer term, the company's entry into real money gaming really does extend its growth runway into the future.
I guess the market's not overly concerned here as well, with its share price certainly being well supported over the past year. And that's also aided by a 1.5 billion share buyback as well, along with strong organic and acquisitive growth opportunities. Looks like the stock will remain a star growth stock, Jace, with consensus suggesting a moderation in the pace of earnings growth over financial year 24, although the return on equity should remain high at 20%. Now, moving onto fertilizer and explosive business, Incitec Pivot. Can we touch on why we decided to remove this stock from borderline star growth stock status?
Yeah, it's a pretty interesting one with Incitec. Now, the company's earnings are highly tied to fertilizer prices, which have almost halved over the year due to supply chain normalizations and falling energy prices. And this has caused IPL's earnings to fall and the ROE to drop below our quantitative thresholds. But Dan, my colleague, also noted other headwinds remain, including inflationary pressures, supply of gas at its ammonia plant, and Foreign Investment Review Board decisions on the sale of its fertilizer division.
Yeah, there's a few active risks there, Jason. Those forecast figures does not look too appealing either, with earnings expected to move lower over the next 2 years. However, this will, of course, be dependent on where fertilizer prices go and whether the business will offload its fertilizer division. This is, of course, a highly cyclical stock. So I think in future, even though we cannot predict commodity prices, we'll need to be careful in covering stocks like these, which appear to be at the top of the commodity price cycle. Jace, quant processes, they don't really work well with these cyclical stocks. So perhaps a qualitative overlay is needed here.
That's right, Kien. And over onto the corporate calendar for next week, we anticipate full year results from government services provider Technology One. There'll also be a few stocks providing their AGM updates, so watch out for our commentary on these. And also, just to quickly touch upon it, Kien, star growth stock Karoon Energy went into a trading halt this week on the back of a material US acquisition. I've released an analyst commentary on this, but we'll discuss the company in more detail in next week's episode.
In Under the Microscope this week, we take a look at diversified financial services firm Macquarie Group. Now, earnings have fallen by around 13% over the year, and that's driven by a slowdown in capital market activity, mergers and acquisitions, and also commodities trading. And let's not forget rising interest rates, which is causing a delay in the sale of its assets. This business has many moving parts, Jay. So can you explain how the business generates its revenue and earnings?
Yeah, that's right, Ken. There's a lot of intricacies within Macquarie's business model, but the main segments are its asset management division, which is involved in managing infrastructure assets like highways and wind farms, the commodities division, which is involved in energy trading, and then we've got Macquarie Capital, which includes equity research, investment banking, like you said, IPOs and capital raises, and also its banking division.
Yes, that provides a bit more clarity on that, Jace, but why was the first half result below market expectations, especially given that historically consensus tends to be quite conservative with its earnings estimates?
Yeah, good question, Keen. The share price was pretty weak after its first half results, which missed expectations, and this was due to a delay in what they call asset realization. Well, what does that actually mean? Well, it means that with rising interest rates, it has become more difficult for the business to offload their assets. And this is due to lower valuations and also making higher debt costs, which can be less attractive for buyers that really do need to use leverage to purchase these infrastructure assets. In addition, lower earnings were generated from less commodity price volatility, and this has elevated due to the start of the Russian-Ukraine conflict, as well as a slowdown in overall M&A activity.
Yeah, very interesting, Jason. These factors have led to a substantial decline in its return on equity below our threshold. In addition, growth is expected to slow over the next half, and that's due to the lack of asset realization, Jace, as you mentioned, over this period. In addition, the earnings mix has become more volatile, with less profits being generated from recurring annuity streams. So this is the reason we've removed the stock from our Star Growth stock universe.
That's right, Kien. And from a income stock perspective, although the company appears well capitalized, the fact that it has chosen to conduct a share buyback of $1.5 billion indicates management's intention to improve its profitability metrics instead of paying dividends. With earnings expected to decline in the coming year, the gross dividend yield of 4.5% doesn't really seem to appear sufficient to offset the risks that investors will have to take. As a result, we have removed the stock from our Star Income universe as well.
Yeah, that share buyback, 1.5 billion, even though it seems quite large in the grand scheme of things, it's actually quite small relative to the market cap of Macquarie. And despite our removal, though, the stock remains a high quality company, which is exposed to global market conditions. And we will reconsider initiating coverage if there are signs of a stabilization across the infrastructure transactional activities, either with positive earnings revisions or when it next meets our stringent quantitative criteria. And for question of the week, with the bank reporting season over, a question that is often asked from our members is, which bank stocks do we prefer, Jace?
Well, it's a very good question, Kien. At the moment, our order of preference is Commonwealth Bank, National Australia Bank, Westpac, and lastly, ANZ. CBA takes the top spot because it has the strongest deposit franchise, meaning that it has access to funds at a lower cost than other banks. In addition, both CBA and National Bank are focused on growth in their business lending divisions, which have higher margins and also less competition compared to residential mortgages. And this is the reason why CBA and NAB are also on lower gross dividend yields versus Westpac and ANZ.
Yeah, quite interesting, lower yields, but possibly higher support for the share price. On the other hand, though, both Westpac and ANZ, they are considered higher risks from our perspective. They continue to focus on the lower margin residential mortgage market and also undertaking a transformational phase, which includes technology upgrades that incorporates pressure on their wages, third-party vendors, and also additional software costs as well.
That's right, Kien. Westpac presently also has the highest cost pressures within its digital transformation, which is trying to integrate the acquisition of the St. George Bank as well as the Bank of Melbourne into its portfolio. In the meantime, if ANZ is successful in acquiring Suncorp, the bank will be subject to additional risks with regards to costs and as well as integration. These risks mean that Westpac and ANZ are also vulnerable to more negative earnings revisions down the track, which could potentially impact their forecast dividend yields.
Yeah, for now, I think those dividends look sustainable, but I guess that's why they both are trading at forward gross dividend yields of over 9%. Well, that's all we have time for today. Thanks, Jace, for your insights.
Thanks for having me, Kien.
And for those who have any questions on today's episode or stocks in general, please come along to our Lincoln Live webinar on Monday. But just to summarize, the inflation and interest rate landscape is constantly changing, but it's important to separate the facts from the noise and focus on the business fundamentals, those financially healthy businesses. And bank dividends, they appear sustainable for now, but not all banks are the same. So from our perspective, there is a reason why Westpac and ANZ are paying more attractive dividend yields. Take care and have a happy, healthy, and prosperous week ahead.